Investing in gold offers diversification and potential inflation protection, but deciding how to invest can be daunting. Physical gold, bars, coins, and exchange-traded funds, ETFs, offer distinct advantages. As we begin 2026, let's examine what smart money investors are considering when choosing between these two approaches. Defining smart money in 2026. For this analysis, smart money refers to institutional investors, hedge funds, pension funds, sovereign wealth funds, and sophisticated individual investors who are well-informed, conduct thorough research, and prioritize long-term value. Physical gold, pros and cons. January 2026. Pros. Tangible asset. You own the physical gold outright. This can provide a sense of security and control. No counterparty risk. Unlike ETFs or other financial instruments, physical gold eliminates the risk of a brokerage failing or a fund manager making poor decisions. It's yours. Privacy. Transactions can be conducted privately, particularly with smaller purchases of coins or bars. Potential for estate planning. Physical gold can be easily passed down to heirs. Cons. Storage costs and security. Requires secure storage, which incurs costs, safe deposit boxes, private vaults, and carries the risk of theft. Liquidity. Selling physical gold can take time and effort. You may need to find a reputable dealer and negotiate a price. Spreads, the difference between the buying and selling price, can be wider than for ETFs. Verification. Ensuring the authenticity and purity of physical gold requires expertise and potentially costly assays. Insurance. Requires insurance to protect against theft or loss. Transaction costs. Buying and selling often involves premiums and commissions. Gold ETFs, pros and cons, January 2026. Pros. Liquidity. Gold ETFs are highly liquid and can be bought and sold easily on stock exchanges. Low storage costs. No need to worry about storage, security, or insurance. These costs are borne by the fund and reflected in the expense ratio. Transparency. ETF holdings and valuations are transparent and readily available. ETFs are easily accessible through brokerage accounts. Diversification within gold. Some ETFs hold a basket of gold-related assets, for example, gold mining stocks, offering slightly different exposure than just the spot price of gold. Cons. Counterparty risk. ETFs are subject to counterparty risk. Although most ETFs hold physical gold to back their shares, there is always the possibility of operational issues with the fund or its custodian. Expense ratios. ETFs charge expense ratios, which reduce returns over time. Some ETFs may not perfectly track the spot price of gold due to management fees, operational costs, and the way they manage their holdings. No physical ownership. You don't own the underlying gold itself. You own shares in a fund that owns the gold. Tax implications. Tax treatment of gold. ETFs can be complex and vary depending on your jurisdiction. This is speculative based on historical trends, but here's a plausible picture. Institutional investors. In January 2026, many institutional investors continue to use gold ETFs as a tactical tool to manage their overall portfolio risk and adjust their exposure to gold. Their large trading volumes favor the liquidity and ease of use provided by ETFs. They might also use derivatives related to gold ETFs to hedge positions. Sovereign wealth funds. Some sovereign wealth funds may hold a combination of physical gold and ETFs. Physical gold provides a long-term store of value and diversifies their reserves, while ETFs allow them to quickly adjust their tactical allocation to gold based on economic conditions or geopolitical events. Sophisticated individual investors. High net worth individuals tend to have a more nuanced approach. They might hold physical gold as a generational asset or for estate planning purposes, while also using ETFs for trading opportunities and tactical allocation. Factors driving the choice in 2026. Interest rate environment. Higher interest rates may make ETFs slightly less attractive due to the opportunity cost of holding a non-yielding asset. Inflation expectations. Higher inflation expectations could increase demand for both physical gold and ETFs. Geopolitical uncertainty. Elevated geopolitical risks typically boost demand for gold, regardless of the form. Storage costs and availability. The availability and cost of secure storage facilities play a role in the decision for physical gold. For investors prioritizing security and long-term preservation, physical gold remains attractive for those seeking complete control and eliminating counterparty risk. Secure storage is paramount. For investors prioritizing liquidity and tactical trading, gold ETFs offer greater liquidity and ease of use for short-term trading strategies. A blended approach. Many sophisticated investors use a combination of physical gold and ETFs, allocating a portion of their portfolio to each based on their specific needs and objectives. Key questions to ask yourself in January 2026. What is my primary goal for investing in gold? Inflation hedge, safe haven, speculative investment? What is my risk tolerance? How important is liquidity to me? Am I comfortable storing and insuring physical gold? What are the tax implications of each option in my jurisdiction? Stay informed and profitable. Subscribe to our YouTube channel. Want to stay ahead of the curve when it comes to gold market analysis? We break down the complex world of gold investing into easy-to-understand content.